Hi guys, I'm Angel Nico Cabrera. As part of our requirements in the subject Strategic Financial Management in Graduate School in University of Luzon, my topic is all about leverage. Let's get started. Leverage results from using borrowed capital as a funding resource when investing to expand the firm's asset base and generate returns on risk capital. Leverage is an investment strategy of using borrowed money, especially the use of various financial instruments or borrowed capital to increase the potential return of an investment. Leverage can also refer to the amount of debt a firm uses to finance assets. When one refers to a company proper or investment as highly leveraged, it means that item has no more debt than equity. Leverage amplifies possible returns, just like a lever, can be used to amplify one's strength when moving a heavy weight. Leverage is the use of the borrowed capital in return to undertake an investment or project. Result, it is multiplied to potential returns from a project. At the same time, the leverage will also multiply the potential downside risk in case the investment down not pan out. The concept of leverage used both investors and companies. Investors use leverage to significantly increase the return that can be provided on an investment. Lever their investment by using various instruments include options, future, and margin accounts. Companies can use leverage to finance their assets. Other words, instead of issuing stock to raise capital, companies can debt financing to invest in business operations, attempt to increase shareholders' value. Investors who are not comfortable using leverage directly have a variety of ways to access leverage indirectly. Invest in company that use leverage the normal course of their business to finance or expand operations without increasing their outlay. Leverage refers to the use of debt to amplify returns from investment or project. Investors use leverage to multiply their buying power in market. Companies use leverage to finance their assets instead of issuing stock to raise capital. The difference between leverage and margin, although interconnected, since both involve borrowing, leverage and margin are not the same. Leverage refer to take on debt, while margin is debt or borrowed money a firm uses to invest in other financial instruments. A margin account allows you to borrow money from a broker for a fixed interest rate to purchase securities, options, or future contract in anticipations of receiving substantially high returns. Example of leverage. A company formed with an investment of 5 million from investors. The equity of the company is 5 million. This is the money the company can use to operate. If the company uses debt financing by borrowing 20 million, it now has 25 million invest in business operations and more opportunity to increase value for shareholders. An automaker, for example, could borrow money to build a new factory. The new factory would enable to automaker to increase the number of cars it produces and increase profits. The disadvantage of leverage. Leverage is a multifaceted, complex tools. The theory sounds great and the reality is used to leverage can be profitable, but the leverage is also true. Leverage magnifies both gains and losses. If an investor uses leverage to make an investment moves against the investor, their loss is much greater than it would have been if they have not leveraged the investment for this reason. Leveraging is among the plays best avoided by first-time investors until they get more experience under their belts. Financing plan, break-even, operating and leverage, and financial leverage. Financial planning primarily involves anticipating the impact of operating, investment, and financial decisions on the firm's future financing positions. Short-term financial planning refers to the planning functions as it applies to 1 year period, and a long-term financial planning usually refers to 3, 4, or 5 years. Budgeting. Budgeting is an important management technique. Budgets reflects plans that are considered likely to achieve organizational goals and objects. Actual period budget serves also as a management control device. Sales budget is prepared first. This will incorporate forecast about selling price and expected sales volume for each type of product. The budget for marketing, sales, and distribution would also be made at early stage because estimate of spending on sales, promoting, and advertising will be necessary to gauge expected volume of sales. Having prepared a sales budget, it would be possible to estimate production requirements. However, a decision must be taken first about stocks of finished goods. Decision to increase stocks would mean that production much exceed the sales volume. On the other hand, a decision to reduce stock level so as to improve the company cash position would mean that product volume would be less than forecasted sales volume by the amount of the rundown in stock. Product budget is followed by the budget of resources production. Number 1, material purchasing budget. 2, labor budget. 3, production overhead budget. In order to prepare the purchase budget, a decision must first be taken about stock levels. Purchase requirements are the usage of requirements plus any increase in raw material stock or less a decrease in stock. The similar consideration would be given as a change in creditor. Financial forecast. Short-term financial planning requires the develop of 3 forma projected statements. A pro forma income statement is simply a forecast of expected revenues, expenses, and profits over some planning period. It provides information about the future performance. A cash flow budget is detailed estimate schedule of future cash, the receipts, expenditures, outflows. The cash flows budget provides information about future liquidity, enable managers to predict both magnitudes of and timing of cash deficits and surpluses in the future. Pro forma balance sheet is a direct estimate and expected ending value of all assets, liability, and equity accounts for a future planning period. Income statement. An income statement is a reports a firm's performance by measuring the profit losses generated over a period of time, typically a fiscal year. The sections of income statement, number one is the gross profit, net sales minus cost of goods sold. Number two, net operation income, gross profit minus operating expenses. 3. Net profits before taxes, taxable income. Net operating income minus interest payment plus non-operating income. Number 4. Net incoming after taxes, taxable income minus tax. Retained earning, net income minus dividend. Cash flow statement. The cash flow statement determines the flow, cash inflow, and cash outflow based on operations, financial, and investment decision. Next, the accounting balance sheet. Accounting balance sheet is the summary of a firm financial position, its asset and claims on those assets in particular time. Typically, the last day of year, the name of the assets and their respective values are listed in increasing or descending. Liquidity refers to the speed and ease with which an asset can be converted to cash. Highly liquid asset is the one that can be quickly sold without significant loss of values. An illiquid asset is one of that cannot be quickly converted to cash without substantial price reduction. Fixed assets are for the most part uh, relatively illiquid. Liquidity is valuable. The more liquid a business is, the less likely is to experience financial distress. That is difficult in paying debts or buying needed asset. Balance sheet is a snapshot of a firm. Convenient means of organizing, summarizing what a firm owns, its asset. Firm owes its liability, and the difference between these two. The firm's equity at a given time. The left hand side list an asset of firm, and the right hand side list the liability and equity. Assets are defined as probable future economic benefits obtained. Liabilities are probable future sacrifices on economic benefits arising from present obligations defined similar as a particular entity to transfer assets or provide service to other entities in the future as a result of past transaction or event. Assets are normally divided into two categories. One is current asset and non-current long-term asset. Fixed assets are expected to provide benefits and service over period longer than 1 year. Fixed asset can either be tangible, such as truck or a computer, or intangible, such as a trademark or patent. Accountants refers to these assets as capital assets. Current assets are those resources that will be converted to cash within 1 year or within the firm's normally operating cycle. A current asset has a life of less than a year. Next is the stockholders' equity. Indicates stockholders with a bookbind term. This simplifies the actually wealth of shareholders. Next is the long-term liabilities, such as bonds and mortgage are payable in more than 1 year. We use the term bonds and bondholders to refer as a long-term debt and long-term creditors. Current liabilities, obligations that must be paid within a year or within a firm's operating cycle. Net current assets is refers to the difference between current asset and current liabilities. Net working capital is positive when current assets exceeded current liabilities. Break-even point. Presentations that value of production cost equal and then loss. Products that fall below the point is their loss. And if output exceeds that point, there is profit. Sales revenue, total cost or sales minus variable cost is equal to contribution equal to fixed cost. It can be concluded that at break-even point, that contribution earned just covers the fixed cost, and at levels below the point, contribution earned is not sufficient to make the fixed cost, and at level above the point, contribution earns more than the recovered fixed cost. Assumption underlying break-even analysis. The break-even analysis is based on certain assumptions. Number one, there are all costs can be separated into fixed and variable components. 2. Fixed costs will remain constant at all volume of output. 3. Variable costs will fluctuate in direct proportion to volume of output. 4. Selling price will remain constant. 5. Product mix will remain unchanged. Next is the number of units of sales will concede the units product so that there be no opening or closing stock. Number 7, productivity per worker will remain unchanged. Number 8, there will be no change in general price level. Next is the operating leverage. Operating leverage is the cost accounting formula that measures the degree to which a firm or project can increase operating income by increasing revenue. A business that generates sales with a high gross margin and a low variable cost has high operating leverage. Calculating operating leverage. For example, company A sells 500,000 products for a unit price of 6 pesos each. The company's fixed costs are 800,000 pesos. It costs 0.05 in variable cost per unit to make each product. Calculate company A degrees of operating leverage. A 10% revenue increase should result in a 13.7% increase in operating income. The solution is 10% times 1.37 is equal to 13.7%. What does operating leverage tells us? Operating leverage formula is used to calculate the company's break-even point and help set appropriate selling price to cover all costs and generate a profit. The formula can reveal how well a company is using its fixed cost item, such as a warehouse and machinery and equipment, to generate profit. The more profit a company can squeeze out the same amount of fixed asset, the higher its operating leverage. Example of operating leverage. Microsoft costs are fixed, such as expenses from upfront development and marketing. With each dollar in sales earned beyond the break-even point, the company make a profit, but Microsoft has high operating leverage. Conversely, Walmart retail stores that low price cost and large variable costs, especially for merchandise. Because Walmart sells a huge volume of items and pays upfront for each unit it sells, it costs a good sold increase as sales increased because of this. Walmart stores have low operation leverage. Financial risk. A company's financial risk is related to the company's use of financial leverage, debt financing, rather than the operating risk of making the company profitable enterprise. Earn the company's ability to generate sufficient cash flow to be able to use interest payment of financing or other debt relation obligation. A company is relatively higher level of that debt. Financing carries a higher level of financing risk. There's a great possibility of company not being its financing obligation and become insolvent. And my last topic and the special considerations of business. Business risk is often categorized into systematic risk and asystematic risk. Systematic risk refers to a general level of risk associated with any business enterprise. Basic risk resulting from fluctuating economic, political, and master conditions. Systematic risk is an inherent business risk that companies usually have little control over, other than their ability to participate and react to changing conditions. Unsystematic risk, however, refers to the risk related to special business in which a company is engaged. A company can reduce its level of unsystematic risk through good management decisions regarding cost, expenses invested, and marketing, operating leverage, and free cash flow are metrics that investment uses to assess a company leverage efficiency and management of financial management. That's all. Thank you.